Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. I'm seeing folks already waiting. So if you're in the chat, I'd appreciate a thumbs up to let me know that you can see and hear me. While you're doing that, a couple of things. First of all, so this is a live Q&A. So there are folks in the chat, they're going to ask questions. I'm going to do my best to answer them. Or you can just put in a topic you want to talk about. But the one thing to do is please tag me because it shows up as orange in the chat because I'll ignore everything else. So I see Fast Eddie 333, not to be confused with Fast Eddie 332, gave a thumbs up. Salty, not to be outdone, I think 9, but 9, no 8 thumbs up. So there you go. So I'll let you guys. I'll give you a few minutes to start putting some topics and questions in the chat. Did you guys watch the market yesterday? So this is just the crazy thing about the stock market. So it was up, like a gajillion points. I mean, it was up. The S&P was up. I don't know, 1.5%, 2%. Every stock was green that I track on my in the stock app. Today it's kind of a mix, but yesterday it was all green. And the news broke. A shocker, I'm sure, that Omicron had reached the United States. There was a positive, test in the U.S., and the stock market just took a nosedive. And I'm thinking, well, I mean, did people actually think it would not come here to the U.S.? I don't know. I guess maybe the market didn't. I don't know. Anyway, it shows you the craziness of the market, even on just a minute by minute basis. So a couple of other things. I am working on a video that I hope to publish tomorrow, but we'll see, on bond investing. And the reason is I'm getting literally almost on a daily basis emails from folks. Should I invest in bonds? They're expensive. One person wanted to know if the NAV, the net asset value of a bond fund, will actually go down over whatever the next decade. So I'm working on a video that will be for beginners just starting to invest all the way through to folks who have been investing for a long time and are just wondering what should we do with our bond portfolio. And but the one thing I wanted to mention, there is, we mentioned duration, so that you can sort of predict how either falling or rising interest rates will affect a bond fund. And we've been through this many times, but let me pull it up on the screen here. I'm in let's see. That's not what we want. Oh, rats. I got to change something. Hang on. No, that should work. Why doesn't that work? Oh, there it is. Okay, we're good. That's what Morningstar looks like. All right. We're going to look at just BND, which is a total bond market fund from Vanguard. We could look at any fund. And if we go to portfolio, we can find the average they call it effective duration. It's right here. And it's 6.83. We'll just call it 7. Those are years. That's what that means, 6.83 years. And so as a general rule of thumb, what this means is that if interest rates go up by 1%, the value of this fund will go down by 6.83%. And the reverse, it's true. If rates fall by 1%, the value of the fund will go up by 6.83%. And that's just generally how bonds work, right? If you have a bond paying 2% and rates go up 1%, your bond's value goes down. You might not sell it. You may not realize that loss in value, but it has gone down. If you tried to sell it, who wants to buy your 2% bond when rates have gone up and they can get the same thing at 3%, right? So you'd have to discount it. You'd have to sell it for less than the face value of the bond, less than in a sense, the amount that you lent to the government or a corporation or whatever. And of course, the reverse is true. If you've got a 2% bond, the rates go down by 1% to 1%. Well, look at you. You've got a bond paying more than what the market currently pays, so you could sell yours at a premium. So bond funds work the same way. But that raises the question, okay, fine, but what's going to happen longer term? Like over the next 10 years? Of course, we don't know what rates are going to do, but you actually can predict the long-term returns of a bond fund, particularly one like most of what we look at, including B and D. These are funds that try to maintain a constant maturity. So we're looking here, the effective maturity is 8.8 years. I won't get into the difference between maturity and duration, although I guess I can if you guys in the chat ask about it. But it's pretty simple, really. Maturity is just the average time until the bonds in this portfolio mature, meaning they come to an end. It's like the end of a CD term. They come to an end, and the borrower, the government, a corporation, whatever, gives you your principal back, right? So the average here is 8.8 years. You could think of this as a weighted average of when you'll get your money back. And you're like, well, wait a minute. I'm going to get it back in 8.8 years, right? Why would the weighted average be different? Well, because you're actually going to get some of your money each year in the form of interest, right? And so it affects this duration. You can think of as sort of calculating in those interest payments. In any event, there is sort of another rule of thumb that's been well documented in study after study. And the formula is a little different from time to time, but here's basically how it works. Take the duration of a fund. We'll just, for math simplicity, we'll call this 7 years. You double it to 14, and then you subtract 1. That's not too hard. I'm an English major. I can even follow that. 7 times 2 is 14 minus 1 is 13. 13 years. What does that mean? That over the next 13 years, this fund should average returns roughly equal to its current yield. All right, Rob, I know what you're asking. Rob, what's the current yield? Well, 1.9%. And you're saying, you're telling me if I invest in B&D, which is like the recommended fund for the 3-fund portfolio, I can expect to earn under 2% on average over the next 13 years? Are you kidding me? No, I ain't kidding you. Now, as bad as that may seem, what do you think stocks are going to do over the next 13 years? I don't know. Over the first decade, they lost money. So as bad as you think this is, stocks could be worse. So you got that going for you. I will have one caveat. This whole duration times 2 minus 1 is assuming a lump sum investment right now, right? It's not assuming, monthly investments into a 401k or an IRA or whatever, because those investments get made at different price points, right? Whatever the bond fund is trading at when you make the investment. So it's really kind of more important for folks like me who are either in retirement and aren't making new contributions, or are near retirement. Maybe you're still contributing to a 401k, but the vast majority of your assets are already locked in place and already invested. So this doesn't actually scare me away from bonds, right? Because part of the role of bonds is stability, capital preservation, and those are important things, I think, particularly as you near retirement. But yeah, I mean, the future outlook for bonds is not great. I think the thing that people miss is that with bonds have a certain, particularly if you're dealing with bonds with very limited credit risk, meaning risk of default, which would obviously be U.S. government bonds, and I would even high yield, not high yield, investment grade corporate bonds, where you're not really dealing with credit risk, you're just sort of dealing with interest rate risk. All of this comes out, there's mathematical sort of certainty behind all of this. And with stocks, there aren't, right? It's not the same thing. But the fact of the matter is, stocks are extremely expensive. And so the outlook for the next 10 years is not great, particularly US stocks. There are other areas of the market that are less expensive, emerging markets, maybe even some aspects within the US market, but like an S&P 500 is pretty expensive. And you say, okay, that's true, but that doesn't mean stocks will go down. Well, that's also true that bond rates don't necessarily need to go up. I mean, there's about 14 trillion in debt in the world that's yielding a negative yield, and these are nominal rates. We're not talking about inflation linked bonds like I bonds and tips. 14 trillion that are yielding negative. So yeah, I mean, as low as we think the rates are now, they can go down. I can remember, when rates went up to like 15, 16%, this was late 70s, early 80s, I had a 6-month CD at 16%. And in fact, if we look at the 10-year, I'll show you this on the screen in a second, 10-year Treasury yield, the Fed has, which is the Fed, their St. Louis Fed, they call it the Fred. I don't know what that stands for. I should know that. Anyway, here's the 10-year yield, and we'll go to the max. It goes all the way back to, what is this, the 60s. Let me try to make this a little bigger for you. There it is. So, I mean, look at these jumps. So, like, think about here. Let's say we're in June of 1980, and the rates are at 10%. They were a little higher before that, but by and large, they're about as high as they've been ever, or certainly in the lifetimes of people living in the 1980s, which, by the way, would include me. But look at this. From June 1980, they went all the way up, let's see, in a little over a year, they went up 6 percentage points. Yeah, so bonds can fool you. And then, of course, they just drop like a rock back down into the 10s. Then they go back up again. So this idea that we can predict, we just can't. So for all we know, over the next decade, I don't know, rates could go lower. We just don't know. So yeah, I'm working on a bond video. All right. By the way, I will do a timestamp below this video when it's done. So, and Salty, I was not coming back from the gym. The gym is going to be after the live stream. I was playing chess. By the way, no chess puzzles on this live stream. That's the other announcement. What I've decided to do, I set up a Twitch account, and I'm going to start streaming my chess stuff on Twitch. And so those of you that are, the 4 of you that are interested, I'm going to drop that link in the chat. That's my Twitch account. I haven't set up a schedule yet. I don't know if I will. But, one of the things that I'll do is, like, if folks want to play, like, and you have a chess.com account, I can live stream and we can play, a 3-minute game, a 5-minute game. You guys can destroy me, I'm sure. All right. So I'm going to the chat now, and we'll talk about efficient market. So Salty thinks that the efficient market theory is bogus. So the idea of an efficient market is that, we all sort of know the same thing. There's all this data out there. We all kind of have it. And at any particular time, the value of a security. And remember, security is not just a stock, it's a bond as well, right? Bonds are obviously publicly traded. When I was at the Public Company Accounting and Oversight Board in the Enforcement Division, we only had jurisdiction over the financial audits of an issuer, right? An issuer is a defined term in the securities laws of the United States, but it would include a company that had no public equity but had public debt, right? They would be an issuer. In any event, I don't know why I went down that rabbit hole, but the idea is we have all this knowledge and it's all baked into the prices. And I tend to agree with what Salty says, that I think you can see a lot of mispriced assets in the market at various times. I think over the long term, if you think about stocks, I think their prices eventually reflect fundamentals in the long term. But you can have all kinds of mispricing, and part of it is, some folks are investing for the short term. They don't plan to stay in a position long. Other people are going to stay maybe for an intermediate period of time. There are others that are buy and hold, and they're going to hold for decades. And so, for someone who's, investing in the short term, there may be good reason to sell, pick a stock, I don't know, whatever. But for someone who is a long-term investor, there'd be no reason to do that. And so some of it comes down to the individual investor. Some people sell not because they have some belief that it's not a good investment. They just need the money. I mean, there's just so many variables to say that the market is perfectly efficient and that things are always reasonably priced doesn't really make sense to me. Now, the bigger question, I think, is what does that mean for you and I as investors? And I think for the vast majority of people, and myself included, that most of our portfolio should just be in low-cost index funds. I suppose some arguments can be made for actively managed funds, but generally low-cost index funds, because we're not good at understanding, I think for the most part, valuations. It takes a lot of work to really understand a reasonable valuation of a company. It takes a lot of control over your emotions. And so for most people just don't want to spend the time on it. Yeah, there's some that do. And I have some of our portfolio in individual stocks, but for the most part, I don't, my belief that the market isn't always efficient doesn't change my approach to investing. Um, by the way, did you notice my new chair? Yeah, I'm comfortable now. I can't believe I waited so long to get this thing. It's phenomenal. All right. So Vinyl says he's buying stock every month, no matter what the market does, but only a small amount. He's retired, but still a net saver, which is a great position to be in. And I think that's what the vast majority of us should do. I mean, not, in retirement, that's an exception, I think. But, I don't, when I was saving up, I didn't, making contributions each paycheck into a 401k, maybe once a year into an IRA. I always invested in my IRA once a year, but uh, yeah, I did it regardless of what the market was doing. And I've just learned over 30 years of doing this that I can't predict the market. I mean, if we go back to this just for the 10-year treasury yield, when we're down in this period here, 1 to 2%, I mean, I guess it went over 3. I would have never guessed in in a million years that it would go down. And by the way, it went down even before COVID. I mean, it was going down in 2018. That was weird. Did you guys just see the screen flicker? In any event, I would have never guessed that. And coming out of COVID, I would have expected rates to continue to go up, and then they didn't. They went up to like 175, and then they came back down. So, yeah. All right. Curious Mind. Hey, Rob, thanks as always for answering our questions. Could you comment on holding ETFs versus index funds in taxable brokerage accounts for those who have maxed out their tax deferred accounts? So I think it's a practical matter when you're dealing with the kinds of index funds we typically talk about, very large, lots of assets under management, highly traded, whether it's a Schwab fund, Fidelity, Vanguard, that from just a pure investment perspective, it doesn't much matter. With an ETF, you have to always think about whether the price it's selling at either a premium or a discount to the net asset value. But for these kinds of funds, it's almost negligible. I mean, it's really, really tiny window. In fact, just look at this. B&D, we were looking at a second ago. It's a bond fund, right? Let me show you the screen. You can see here the bid-ask spread is right here. I mean, it's 1 penny. So actually, it's interesting. I look at this. It's actually selling. Bid-ask is under. It's actually under the NAV. It's interesting, but the spread is very, very thin. And usually, when I've looked at it, I frankly I don't pay a lot of attention to this. I've thought it was a little bit closer to the NAV, but actually, it's lower, right? So. But that's the one issue that you have to keep in mind with an ETF is, let's say you're wanting to sell this, you're going to get right now it's priced at 85.28, even though it's got a NAV of 85.46. If this were a mutual fund, and you're selling back to the mutual fund company, right? And they're going to always give you the NAV as of the last close, right? But by and large, I don't think it matters. The one issue would be if you want to buy, for example, a Vanguard mutual fund, but your account is at TD Ameritrade or Fidelity or wherever, in most cases, they're going to charge you a fee. Whereas if you buy the ETF version, they're not. So, I would probably, I start to say I'd probably go with the ETF version. Part of that depends too on how often you trade. I trade very little. They could charge me $100 a trade. It wouldn't matter. I mean, practically speaking, I'd rather not pay it, but I mean, it's not like I literally, so far this year, I've not sold a single mutual fund share. In fact, the only thing I've sold this year was some Apple stock we gave to charity. That's it. So, if you don't trade a lot, doesn't much matter. But for these kinds of large, actively traded, highly liquid funds, mutual fund versus ETF, I really don't think it matters. What'll dictate it more likely is where you're investing. Obviously, if you're at a Robinhood or an M1 Finance or a robo-advisor, Wealthfront, Betterment, they all use ETFs. But I have a video on it. If At Vanguard, I just buy mutual funds. I don't want to have to worry about the spread. I don't have to worry about the premium or the discount. That's what I would choose. And if I'm at Vanguard and I'm buying Vanguard fund, or if I'm at Fidelity, I'm buying Fidelity fund, it's free. So I just go with the mutual fund. I don't care about the price changes throughout the trading day. Yeah. So that's my take on that. So Salty wants to know, with a 70-30 portfolio, what is a reasonable expected return given the stupidity of the current market? Well, the first thing you'd have to decide is over what period of time, right? Because if you say over the next 50 years, I mean, I don't know. It also would depend on what that 70, which I assume is the stock allocation, is invested in. Is it all US, which is not something I would do? Or do you have some of it invested internationally, which is, their markets aren't quite as stupid as ours, to borrow your expression. But I don't know. Morningstar came out with that report that said the new safe withdrawal rate based on expected future returns is 3.3. And I've not actually even read the thing yet, and I need to. I'm looking over here. I've got it somewhere. But I'd be curious what expected returns they use. My guess is they looked at a decade, but Vishnu says, do you recommend investing in tax-advantaged accounts if you are planning to retire early? Generally, yes. Like if I'm 25 and I want to retire by the time I'm 50, there's a lot of good reasons to still invest in tax-advantaged accounts like a 401k or an IRA. Obviously, the tax advantages with a 401k or other workplace retirement plan, you may have employer matching, in which case, to me, it's critical. I mean, that's just, free money. And there are plenty of ways to get at it. I do think there's some planning that could go into this. So, for example, keep in mind, let's say you have a 401k or 403b, you're contributing to that, and you've got a Roth IRA. Well, remember, you can take contributions out of a Roth IRA at any time, tax and penalty free. So you can't do that with the earnings, and conversions into a Roth IRA are treated differently, but contributions, tax and penalty free. And so, that would be one way to fund some of your retirement living before you reached 59 and a half. You can always take money out of like a 401k in substantially equal payments. And let me pull up the IRS page on this, and I'll real quick. Substantially equal periodic payments. Here it is. So if you just Google this, it'll tell you all you need to know about what's called substantially equal periodic payments. There are a lot of sort of things to keep in mind, but you'll see them as you read through this. This is actually, if you think of the IRS as like impenetrable, you can't understand the rules and regulations, but they've really done a good job of writing content like this for folks like you and me, which is to say non-tax experts. So you've got that. If you retire at 55 or older from your current job, well, obviously, and you have I guess what I meant to say, and you have your 401k at your current job, meaning you haven't rolled it over into an IRA, or we're not talking about a 401k you have at a previous employer, but the 401k at your work when you retire at 55. By the way, it would be okay to take a prior employer's 401k and roll it into this one. It would be okay to take a rollover IRA and roll it into this one if your employer allows it. But you retire at 55 or later or older, you've got your 401k there. You can take money out of it. There's a rule, an age 55 exception, so you can Google that. And then, of course, you may be saving some of your money in taxable accounts, right? So, but to answer your question, I mean, and there could be exceptions to all of this, but I would definitely take advantage of tax advantage accounts. And by the way, that says nothing of HSAs if you have a high deductible healthcare plan, which of course you can take money out of. Think about this. You can take money out of it at any time, tax and penalty free, if it's for qualified healthcare expenses. But here's the other thing you can do. You can save money in the HSA year after year after year, not spend it. As you have medical expenses, and you might set up a threshold like anything over $100 or whatever. save those receipts, because you can always use those receipts to pull money out of the HSA 15 years from now. So this is where the planning is important. So you might, who knows, you might have a year's worth of living expenses saved up in healthcare receipts by the time you decide to retire early, and you could take the money out then. So yeah, I think I would definitely use it at tax advantaged accounts. I didn't really think about retiring early really until the last, I don't know, 5 or 10 years. And I guess I'm still not really retired. I'm sitting here talking to you guys. This is my job. Not bad. Kevin says, I think you should do a video on withdrawal strategies. If you have already covered that, forgive me for not combing through all your work. Well, I have covered it to some extent, and I'll show you where you can find it. Bear with me here. I got to find my YouTube channel. And then I'll put it on the screen for you. So here's my channel. There's the live stream right now. And I've got playlists down here. And I've got one called the 4% rule. And it covers, I'm trying to think. It's funny what some of the things that I have put into this playlist. Yeah, I need to add to this. This is a starting point. The thing is that, so anyway, you can find that, but I need to add to it because I think the 4% rule is good for planning purposes. It's easy. You can just say, okay, I need 25 times my annual expenses to retire, right? The devil's in the details. First of all, there's a big difference between retiring when you're 40 and retiring when you're 70. There's a lot of folks don't want to retire and just barely get by. There's that problem or reality. But the bigger issue is that I've yet to find anyone who actually uses the 4% rule in retirement. That is to say, in year one, they take out exactly 4% of their portfolio, and every year after that, they adjust for inflation. We don't live that way. Studies show that we spend less as we age, even, by the way, as our healthcare costs go up. But our expenses overall go down. And at least in my experience with every person I know or have known, say in their 80s and 90s, it's absolutely true. I don't know a single person that's an exception to that rule. I'm sure they're out there. But the other thing is that, we tend to react to the market. If the market's up 20, 30%, we feel a little more free to spend a little more money. And if it's crashing and it's down 20 or 30%, we tighten our belts, And really the video I need to do is on guardrails. And the basic concept, in fact, Kitsy's, let me just see if I can find Kitz's article on this. There's a lot of different folks that have talked about guardrails. Michael Kitz's KITCES.com is one of them. That's his site, obviously. Guyton Klinger, those are two guys that have academics that have done a lot of work on it. Wade Pfau, P-F-A-U, I think, has done a lot of work on it. I want to just show you an article that I thought he published recently on this, but I'm not seeing it. So maybe it's an older article. But in any event, the basic idea, here we go. The retirement, here, I'll just bring it up. It's called, I haven't read this article. He just published it, a couple days ago, a week ago. The Retirement Distribution Hatchet, Using Risk-Based Guardrails to Project Sustainable Cash Flows. So you guys can check that out. But the basic idea of guardrails is to say, look, I may start with 5%. And assuming I need to spend that much, and I might even adjust it for inflation. However, each year before I actually make the withdrawal, I'm going to take the amount that the formula tells me to withdraw. I'm going to divide it by my total portfolio, and I'm going to look at the percentage. What percentage of my nest egg would I be withdrawing if I follow the rule? Say, again, even starting at 5% and adjusting for inflation. And if the percent that I get is somewhere between 4 and 6, I'm good. Fine. Take it and spend it if that's what I want to do. If it's above 6, though, I'm going to cut back. And why would it be above 6? Well, because the market's cratered, right? So my portfolio value was much lower, and or inflation was going through the roof. So my annual adjustment was high, right? That could call either one or both of those could cause the amount I'm taking out to exceed 6% of my portfolio. And if it's below 4%, that means the opposite, right? The markets have been up and or inflation's really low. And if that's the case, if I want to, don't have to, right? These are just guidelines. I could take out more. I like that approach. I just think it's a more realistic approach. Now, there are other ways to create guardrails. Guyton Klinger talk about one guardrail could be not increasing your distribution for inflation in any year in which your portfolio is down. Now, what I don't have a lot of is a lot of back testing on that. And I've mentioned that I'm working on my investment spreadsheet. I want to do a lot of new things to it. One of the things that I want to build into it is the ability to back test guardrails, at least based on historic data. I haven't thought through Monte Carlo analysis yet. In terms of tools, probably the best one out there, well, there's always personal capital, but I think new retirement's pretty good. It does a lot, and it includes Monte Carlo analysis, but it doesn't back test guardrails. It doesn't do that. Okay, that's my answer. Hope that helps, Kevin. But yes, I will do a video. Let me make a note. I'm going to make a note on my AARP bulletin. Yeah. I'm that old. Okay. What do we got next? What is my chess.com handle? So, I used to own doughroller.net back in the day. So my chess.com handle is doughroller. I didn't sell that. All right. Josh, good morning. Good morning to you, sir. Currently have a 3-fund portfolio with an 80-20 split, which means 80% in stocks, 20% in bonds. Thinking about switching to Schwab Index Target Date Fund. Your thoughts? Josh is in his 30s, hopes to retire by his 60s. It's funny, I just published on robburger.com what I consider to be 4 really good target date retirement funds. I didn't include Schwab. One of them that I included actually is M1 Finance, and the reason is, in addition to the fees being the lowest, they're 8 basis points. Although, no, did I include Schwab? No, I didn't. I didn't include Schwab. I'm just double checking. I'll show you this on the screen in a second. Let's see here. I don't think it's funny. I just published it. You think I would know like what I put in it. No. And I know there was a reason. Here's the Schwab target date page. And generally, I like Schwab funds. And this could be good too. I'm not suggesting that their funds are not good. We're going to take a look at it together. Here are the things you have to think about with a target date fund. One is it an index fund or not? Not all target date retirement funds are implemented using index funds. In fact, Fidelity Freedom has 2 versions. One that uses actively managed funds and charges, 70 some basis points, and one that uses index funds and charges, I think, 12 or something like that. But then, of course, related to that, you need to understand the fees and then the asset allocation. When you're like Josh and he's 20 plus years away from retirement, the asset allocation is probably going to be good. We'll look at it. The bigger issue comes when you get close to retirement, because I think a lot of the target date funds get way too conservative for most people. They go well below 50% in equities. By the way, one of the reasons I like M1 Finance, in addition to the fees, is that their 2020 aggressive, first of all, they offer 3 different versions of every year: conservative, moderate, and aggressive, which the other fund families don't. But for their 2020 fund, something you would own, say, when you just retired, they have an aggressive option, which is about 60-40, and the other, which is reasonable. It's not certainly the only portfolio to own in retirement, but I think it's reasonable. But the other funds don't. They're all well below 50. So let me, why is Schwab? I'm going to find a different page. Here we go. So you would want, let's see, you're going to try in 23. So maybe you would want the 45 fund. So that's 2045. Let me pull this up and I'll put it on the screen. And we're going to look at it at Schwab, and we're also going to look at it in Morningstar. This is good. So here's their 2045 fund. So here's one issue to think about. 68 basis points. That's pretty expensive. That tells me it's actively managed, although I shouldn't assume that. We'll look. And that's why it didn't make my list. I'm just a big believer in low fees. And I'm just looking. So let's look at this. This is interesting. So this is the glide path. Glide path just means how does the stock bond allocation change as you near retirement, right? And so, and of course you can see down here, they've got this target retirement line here, and you've got all these different colors, which mean, let me just make it a tad smaller. The colors correspond to the different asset allocations. And so you can see, I'm guessing, let's see, it's light blue. It's a little confusing, but I'm guessing at retirement, they're 60-40. No, 40-60, right? This light blue is intermediate. Well, it's either, I guess it's intermediate term bond. Yeah. So at retirement, they're already down to 40% stocks, if I'm reading the glide path correctly. And to me, that's just too conservative. Of course, Josh, right now you're concerned with what their allocation is now, and we'll look at it in a second, I think in an easier. Well, here we go. It's the numbers. There it is. So right now it's 95.5. It's a little on the aggressive side, but I mean, you've still got over 20 years to go. So it's not, I would say it falls within the realm of reasonable. To me, at retirement, that's just it's pretty conservative. And they have what's called a through glide path as opposed to a to glide path. And the only difference is a through glide path, the asset allocation stock to bond continues to change through retirement. And you can see it actually, this is pretty extreme. Most funds are through glide paths. They continue to change for a few years after your target date retirement. I've seen like 5 to 7 years. This one continues to change for like 13 years or something like that. And again, not that that's necessarily bad, but you get all the way down to 25% in equity. It's just not, I just don't think that's a good approach for a lot of people, maybe most people. But again, Josh, you're not at that point yet. So, you don't really need to worry about that other than just to keep it in mind. But for others listening, maybe you're like me, a little closer to that big mutual fund company in the sky. And I just think that's just way too conservative. So that's another reason I didn't care for Schwab's approach. By the way, I said most of the target date retirement funds that I've evaluated are through glide paths. It's interesting. Min1 Finance, as far as I can tell, is not, because they only offer a 2020. That's like Vanguard, for example, offers a 2015. And then eventually they can move you into sort of a retirement income fund, and it's really conservative. So anyway, that's kind of why I'm not a huge fan of Schwab. And we can look at it here in Morningstar. And if we go to portfolio, they give it a 2-star. Honestly, I don't read much into Morningstar stars. It's interesting. They show fixed income of 12. Is this the same fund? SWMRX? Yeah, it is. But Schwab says no. It's 95% equity. I think I'm going to believe Schwab. But in any event, whatever it is, if we come down here to we want to look at the portfolio. So by the way, you can put the ticker here. It takes you to the quote page. I come over here to this portfolio tab, not this one up here, but this one. And then you can scroll down and you can see how the target date retirement fund, or any fund for that matter, invests your money. And with target date retirement funds, they tend to invest, well, I think all of them. They're a fund of funds. So they don't own individual stocks and bonds. They own other funds. And you can see Schwab. It's interesting, Schwab's approach, because they include some Schwab funds, but they obviously include other funds, Dodge and Cox, which is an actively managed fund, but a very good one, by the way. And I owned Dodge and Cox. This is probably at least 15 years ago. I don't know. So I don't have any particular issue with this other than they're just expensive actively managed funds, which I guess is kind of a big issue to have. One other thing I wanted to look at real quick, I think, oh, it's interesting. They don't show it. Oh, because of the holdings. Yeah. I was going to look at the bond portfolio, but to do that, you'd have to dive into each of the bond funds they own. We're not going to do that. So I don't know. There you go. That's my take on it. I'm not a huge fan of it. I think it's expensive, particularly as you get near retirement. I'm definitely not a fan. Joe says, you're a great help to many. I sent an email to you by replying to the investors newsletter email. How deep is your email queue? How long does it typically? So let me first see if I can find Joe's email. So I have a confession to make. I had set up some filters that automatically moved some emails. In Gmail, they give it a label, but they think of it like a folder. Unrelated to the emails you guys sent me, but they got caught up in some of those filters, so I missed a bunch of them. I've since removed them. But let me see if I can find your email, Joe. Yeah, yours must have been one that was caught up. This is a heck of an email. I might publish this as a book. Holy cow. I'm trying. I'll have to read this. This will have to be an offline. This is a lot of detail. And just to give folks, I think I can share this, Joe. I'll just say they have a lot of holdings. Yeah, I have it, Joe. I will read it this week. If you have one or two questions from it you want me to address today, just leave another comment in the chat and I'd be happy to. And yeah, that's one that I don't know what happened to it. It didn't, I searched for it and it came up, but it didn't come into my inbox because I had never even opened it. So I'm still working on the whole email thing. By the way, my queue is I'll never answer all the emails that I have now. I just won't be able to. But, that's why I do the live Q&As. Maybe that's a good alternative. So Scott wants to know, do you have a recommendation for the best way to donate money? Is it possible to donate money out of my IRA if I am under age 70? That's a tricky question. So let me answer the first one. The way we donate money is through a donor-advised fund. We use Vanguard's, but Fidelity has them. And the advantage is you can donate. It's very easy to donate appreciated stock or mutual fund shares or ETFs. You don't pay the capital gains. It doesn't trigger the realization of capital gains. And you get the tax deduction of the full value of what you contribute. And so, because of the recent tax changes in 2017, we sort of changed the timing because without the contributions, we would not itemize our deductions. So it'll be interesting if that changes, by the way, because folks in Congress want to remove or at least change the state and local tax deduction cap. But in any event, we'll see what happens there. And so that's what we do. And the nice thing is the money goes in to a donor advised fund. You continue, so you can never get it back. It's one thing to know. Once it goes in that fund, it's not yours. But you do control how it's invested to some extent. They give you options. And then you control where it goes. Of course, it has to go to a charity. And so even if you only contribute once every 2 or 3 years, you can use the money to give to your favorite charities anytime you want. And what we've started to do is we tend to give to charities in August. And the reason we do is because in talking to the charities we support, what we've learned is that most charities really struggle with cash flow in the summer months because people just aren't giving then. They wait till the end of the year, tax time. So that's just what we do. But now I have to be honest. So one of the things you can do, with your RMD, is contribute it to charitable contributions. I don't know about the whole 70 thing. So let's figure it out. Well, we have the IRS here. Here we go. So I'll go back to the top of this page in a minute so you can find it. Qualified charitable distributions. Generally, a qualified charitable distribution is an otherwise taxable distribution from an IRA. There are some exceptions. Owned by an individual who is age 70 and a half or over. That is paid directly from the IRA to a qualified charity. It can, this is what I was referring to earlier, it can satisfy your required minimum distribution. Tells you how they're reported. So I don't know if that's going to be helpful to you. The 70 thing, I'm not sure what the relevance to the age 70 is. I mean, you've got the 59 and a half age to avoid the penalty. So in any event, I hope that's helpful. And it's just IRA fax distributions. You Google that, you'll find it. I don't know if that answers your question or not. What I just know is you can use it to satisfy the RMD. Jay, I did not mention what I'm going to discuss today. I'm going to discuss whatever you guys want me to discuss. So it's just a Q&A. I've sort of done away with having, I did talk about bond investing to start with because it's been on my mind. But I've sort of done away with coming to the chat with sort of a long list of topics of my own because I want this to be a time for you guys and whatever you guys want to talk about, particularly since I'm having trouble keeping up with my email. So Double Dog wants to know, or I should say Mr. Double Dog Blitz, what's your thoughts on the valuation of Robinhood? Well, I don't have any. We can talk about, but this is good. Because one thing I've been thinking about is how to value Tesla. So I can just walk through generally how I would think about it. And I'll pull something up on the screen here in a minute. Let's try to find the right site here. What's their ticker? Hood? Is that their ticker? I didn't know their ticker. Yeah, okay. So here's Robinhood. Not a lot of data. They just went public this year, right? $20 billion market cap. One of the things, so I would, let's see if they give, let me hang on for a second. The first thing I do is I go to their filings, their SEC filings. And I'm going to pull one up here. Actually, let me just show you how I did this. So I Googled Robinhood SEC filings. The first site that brings up is Robinhood. This is investors.robinhood.com. You could go to the SEC and get the same thing, obviously. And I do that too. Edgar is their name of their, I guess, database, if you will. So you'll notice there are all kinds of filing types. An 8K is a current. So if you think about, let's think about filing. One of the ideas of the SEC and its regulations is to require companies to provide certain information to the investing public, right? And if you think about that, you could say, well, all right, one, what should they provide and how often should they provide it? So what you could think about it is, well, okay, you should really provide a lot of detail. Financials should be audited, everything on an annual basis. But then the SEC, you can think about that. Well, wait a minute, though. Some things could happen during the year that investors should know about. So we're going to add another layer, and we're going to say you have to also do a filing every quarter. Now, the financials, they have to be reviewed by auditors, but they don't have to be audited. And there's, in the auditing literature, there's a huge difference between they call them procedures that they have to walk through for review, then for an audit, but fine. They review it. They review the disclosures. That's on a quarterly basis. Then the SEC says, well, but you know, there could be some things that are so important. We can't even wait for the quarterly filing. You got to notify investors right away. Think a couple of days. And that's an 8K. So you have an 8K is like a current report. The 10Q is the quarterly, and the 10K is the annual. All right. So anyway, I would go to annual filings, and there are none. Well, that's 2021. So 2020, there are none. So they've just gone. I'm thinking this through. They've just gone public, right? I think it was this year. So they haven't had time, I guess, maybe to file an annual report, but they had to file an S1. So let me go back to my screen. So I'm going to pick a registration statement. Now I would think that would be this year. Hey, we got something. And I'm guessing they probably, no, they didn't file anything in 2021. So here's the S1. So this is probably more, I don't know, maybe this is more detailed than you guys want. I'm sure when I get down to the chat, you'll let me know if this is useful or interesting or whatever. So an S1 is what you file when you want to register securities for sale. So you want to go public, right? And then what invariably and that requires audited financial statements. And then what invariably happens is the SEC comes back and says, well, you got all kinds of questions. Boom. And you file an amended S1, and then you file another amended S1, and then eventually you go public or not. So let me just, I'm just going to go to this one because it's got a PDF version. I don't know what amendments they made, but this is one of their first amended S1. And one of the things that I would do, and this would be true of any company, is I want to know how they make money, which may seem silly, right? Like if you think about a deer and company, you think, well, Rob, they make money selling tractors. I mean, how else do they make money? Well, actually, they're a huge financing company. They make a ton of money through financing the sale of their tractors. So companies can make money in pretty interesting and unexpected ways. I don't know the answer here. I mean, I know that there's this whole thing about paying for data that they mine from their users, right? So the first thing I would do is dive into, in this case, I'd normally look at an annual report. We don't have one yet. So, I mean, the S1 will tell you all of this. And this table of contents that you see is all standard. All of this is dictated, more or less, by regulations. So this management's discussion and analysis of financial conditions and results of operation, which is right here. This is all required. You're going to see this language on a 10K and I would read through here and I would try to understand how they make their money. I'm not going to do that in this video because it would take some time, but and I'm just looking, these are some high level numbers that they put in. And I would try to understand that. And I would try to understand how much of that goes to profit. So for that, you could just go to the financial statements, right? And I'm going back up so that you guys don't have to see me scroll forever. Let me go to their financial statements. And they are, they were right below there, which is usually what they do. Well, let me see if I can find them quickly, because I do want to show you a few things here. I'd be curious if they even make money. Here we go. Yeah. So this is the results of operations. This is not their income statement. This is, well, as you can see, it's a table summarizing, but this is fine. And we've got 2019 and 2020, and you can see the revenues skyrocketed, right? At least transaction-based revenues went up substantially. So net interest, right? So they lend money. So they're a bank. Well, they're not I don't know, is Robinhood actually a bank? I don't think so. But in any event, they do some financing activities, which we know because they promote investing on margin, which is one of the reasons I don't support Robinhood. In any event, that's gone up. Everything's gone up. And the year before, we can look at net income and loss. They made, so this is in millions, I assume, or in thousands, so 100, So that's $1 billion, right? This number right here, right? And from that, they made $7 million. So to me, that's a big issue, right? I mean, Can you imagine? I got good news and bad. We made $1 billion this year. What's the bad? Well, we were only able to actually get a 7 million of that to the bottom line. Now, there's a lot of analysis that has to go into why. The problem, I would probably, from an investor's perspective, I wouldn't go any further because I'm confident of two things. The price is going to be astronomical compared to their performance thus far. And while one might argue that you could pay that elevated price based on some future hypothetical growth scenario, I don't have any reasonable basis to believe I could predict with any level of confidence that growth pattern at all. The other thing that would concern me is that they've achieved these results in circumstances that are perfectly aligned to benefit Robinhood. The markets are flooded with cash. The government pumped tons of trillions of dollars into the market. Literally, in some cases, just as we all know, sending out checks, and people had nothing to do but sit at home and trade on Robinhood. All right, some people did. So I don't even need to look at the price. I mean, I would, but I'd probably stop here. If I didn't stop here, I'd want to understand the expenses. I'd want to understand the revenue and where I think it's headed, which the problem here is there's just so little history. You're evaluating a Deere and company. You've got a lot of history to look at. You can look at, good times, bad times in the cycles of the economy, when food prices were high, when they were low. Here, not a lot of data. So I'd honestly just stop there. We can look up their price. Let's so their market, the market cap is 20 billion. They don't really have a PE ratio at this point. They just haven't been out long enough. I mean, when did they start trading? Yeah, it was just a couple of months ago, right? So, yeah, I don't know if that helps you. I mean, in some ways, it's not the best example because you can only go so far. And for me, it's just not a company I would invest in. I mean, by the way, there are a lot of, I felt that same way about Amazon. So it doesn't mean it won't do extremely well. I've missed a lot of great opportunities. All right. Eric, how would you invest a lump sum of $300,000 that we expect to receive from a sale of a home? Should we dollar cost average each month into the 5-fund portfolio or just do it all in one shot? So we get this question every week. The first question is, what are you going to use the money for? I'm assuming it's long-term, retirement, whatever, long-term. And by that, I mean at least 10 years. What I would do is just put it all in, even right now. Having said that, if you're really, really scared and, I don't think it's unreasonable to dollar cost average over 6 or 12 months. I think when most people ask me that question, what they really want to know is which approach will work out better, and there's just no way to know. History tells us that lump sum does better most of the time. However, most of the time, we don't have market valuations that we have right now. So if someone today said, I'm just not comfortable lump summing into the market, I'm going to dollar cost average over 12 months, you certainly won't hear any criticism from me. I would, though, recommend that you put it in writing and you do it no matter what. One of the problems with dollar cost averaging is as the market's going up or down, particularly in unexpected ways, we tend not to follow our plan. We tend to then let the markets dictate and try to time it. At least that's the concern I would have. So yeah, there you go. I mean, it's a good question to ask. One thing too is, one thing to think about, Eric, is do you have money in you said 5-fund portfolio. Do you have money in the 5-fund portfolio now? If the answer is yes, then and you want a dollar cost average to 300, why not take it all out, assuming, let's say, it's in retirement funds and there's no tax consequences? Why not take it all out to cash and dollar cost average everything? Why would you leave any of it exposed to the market if you're afraid there might be answers to that. You might say, well, it's part of it's just the psychological barriers to taking such a large amount of money and putting it to work all at one time. If you've got money already in there and it's been there for years and you're slowly growing the nest egg, we kind of get comfortable with it. We feel the ups and downs of the market, and we've been dealing with this investment portfolio for years, decades maybe, and it's okay. But then we get this big chunk of money, and that feels different, and it does feel different. I get that. I'm not sure how helpful that answer was. Frank says, what are your thoughts on tax loss harvesting? Is it worth the complication? How often and when to do it? Well, I've used tax loss harvesting when the COVID crash occurred. I just before that put money in banks, and it all went down. So I sold and got nice tax losses, and then I ended up, you got to be careful of the wash sale rule. But I ended up putting it back in, and it's done very well. And so, it worked out perfectly. So I think it's something definitely to take advantage of. In terms of timing and how often, I don't really have an answer to that. Part of it's going to be the time of the year, right? Do you want it in this tax year or the next? How big your loss is? What impact it will have on your taxes this year versus what kind of impact you think it will have on your taxes next year, which of course could depend on your income. Maybe one year it's going to be dramatically different. Of course, if you wait, who knows what's going to happen in the market over the next 30 days, and you may or may not have. I don't know how big the tax loss is. So I don't have. There's no sort of one approach to it. I think in my case, because it was part of the COVID crash, everything went down so quickly, and by what, 30% or something like that. It was sort of a no-brainer. I don't remember the timing of when I pulled the trigger on selling the shares at a loss. I don't even remember now which banks. I don't even remember which bank it was. I could look it up. But yeah. Now I will say, robo advisors, Wealthfront, Betterment. I guess SoFi does tax loss harvesting. They really promote that as a feature of their system, obviously for taxable accounts, not retirement accounts, and some even like personal capital. I think Wealthfront maybe they do direct indexing, which is like, think about taking the S&P 500, but rather than investing in a fund, you actually invest in some number of the underlying stocks. Usually not all 500. You can pretty much get the vast majority of the returns and risk of the S&P 500 with much fewer, I think 100, 120 stocks. And then you can tax loss harvest at the individual stock level. Now, I think you and I would never do that on our own, because who's got time for that? But these companies, can use computers to do it. I'm just looking up if Wealthfront has direct indexing. I think they do. Yeah, they do. My take on that, though, is that I really question how useful tax loss harvesting is in the context of a robo-advisor, at least over the long term. Obviously, if you dump a big chunk of money into a robo-advisor in a taxable account and the market goes down, there's going to be tax loss harvesting opportunities that they will presumably take advantage of for you. But think 5 years out, 10 years out, you get to a point where you don't have anything at a loss, and you never will, or if you did, you'll have a lot more to worry about than tax loss harvesting. Your gains over time are huge. Now, I suppose you could continue to contribute new money, and that might be subject to some tax loss harvesting, but particularly after you've been investing for 20, 30 years, that's not going to move the needle much compared to your total wealth. Your new contributions every month generally are going to be relatively small. So, I think some of the robo-advisors are really good. And I think they're a reasonable approach. I'm not sure how valuable their tax loss harvesting is. They have white papers on all of this, but they have to make all kinds of assumptions, and I'm not sure I'm convinced. Vinyl says that studies show that most people don't take anything out of their retirement accounts until they hit RMDs. Yeah, it's kind of interesting. I've been really thinking a lot and talking to some experts on this idea of being overly frugal in retirement. We're scared to death to spend our money. We are. I say we as the collective retired group because you're afraid of running out of money. And the result is for a lot of retirees is they die with a lot of money. I think this idea of the RMDs is a perfect example of that. And we tend to spend the RMD. We almost see it like an annuity payment, because just because you take an RMD doesn't mean you need to spend it, right? And so I was interviewing Roger Whitney, who's the retirement answer man, and he talks about overcoming frugality in retirement. And I think it's an interesting topic and one that I've been exploring. I also interviewed a behavioral psychiatrist who's focused on behavioral finance. We talked a little bit about that as well. Yeah. Stacked Java. I once had a license plate Java law. It was when I was doing litigation over software development projects. And but people always thought I litigated coffee disputes. Anyway, I'm about to implement the 4% rule. I'm 55. My dividend portfolio gives me about 2.9%. So I want to stay close to that as possible. Okay, but there's no question. Did I miss it? Well, Stacked Java, if you're still listening and you have a question, leave it in the chat. By the way, dividend portfolio at 2.9%, that's pretty strong. I wonder I'd be curious what you're investing in because the S&P is at what, 1.2 maybe? Let's look it up. We'll look up SPY, right? What's its yield? 1.24. Now maybe you have some REITs in there. I don't know. Curious what you're invested in to get that kind of dividend. Joe, I got your chat. I won't publish your email. No worries about that. I sometimes the chat forwards me all the way to the end, and then I have to scroll back up. Okay, so I'm back to Stacked Java. Yeah, so I may have missed the question. So if you've got a question, let me know. But 2.9%, I would be curious what you're invested in. All right. Quincy wants to know if I'm traveling overseas at all or waiting until the next year. Well, we're not traveling overseas, but it's not really because of COVID, although I suspect now with the new version, it probably would affect our travels. We were in Greece in 2019, beautiful vacation. We went with another couple, good friends, and it was one of those. So neither my wife and I are planners, and the husband is a big planner. So he planned the whole thing. We rented a car. We drove all over Greece. We went to one of the islands. Food there is phenomenal, just ridiculous. It made me hate Greek yogurt in the United States. It's like, are you kidding me? All right. Neil wants to know if I have thoughts on the Fed chair's remarks on transitory inflation. Well, I don't know what specific remarks you're talking about, but I read into his latest comments that he's really concerned with inflation on a much longer term basis than, if you think about transitory, I mean, everything in life's transitory, right? I mean, we're nothing's permanent that I know of. But I think most people were saying, well, it's transitory, in a couple of months, 6 months, whatever, inflation will settle back down. And I think it's pretty clear now that most folks, including the Fed chair, they don't believe that. Now, that doesn't tell us exactly what's going to happen long term. I can tell you, but I think in his comments, he's like, yeah, we got an issue here, and we're really focused on it. And it'll be interesting to see how their bond buying changes. I think he cut it back by what, 15 billion a month, I think was the number. It'll be interesting to see if that accelerates, because that's what they'll do for now, right? They'll just curtail the purchase of bonds, right? When you think about what that does, right? They buy a bond, they buy some bonds from Chase, and they shove a bunch of money into the market. And of course, that affects interest rates or yields on bonds. So they're curtailing that. The one thing that I've seen that's interesting to me, though, if you think about if we were really, really concerned with long-term inflation, we being the market, how would we see that? How would we notice? Well, I think we'd see 30-year yields going up on the 30-year Treasury, and they're not. So that tells me that the market still thinks that long-term, once we work through all of the implications of COVID, let's say, and I have no idea when that's going to be. When COVID first hit, it was in March, roughly, and here in the U.S., 2020, and I figured by June it'll be done. So yeah, I'm as good at predicting that as I am interest rates. But once we get over the impact of COVID, whenever that is, I think the market thinks that interest rates will come back down based on the bond market. But clearly, in the shorter term, Powell is, I think, very, very focused on it, and I think we'll see it in how they make changes to their bond purchases. But of course, please spell your handle. So this is back to chess.com. I'll just show you on the screen. It's Roller, Doughroller. Let me pull it up. I got to log into my chess account. For those of you, by the way, that are new, welcome. And you say, Rob, what are you doing? Chess? Huh? What? It's a long story. There you go. There's make it a little bigger, maybe. No, I can't. Roller. There's my profile. I've been a member since 2011. My highest rating on puzzles is 2994. See how close I got to 3,000? My blitz rating is down. It was over 2,000. Now it's 1864. So anyway, there it is. The reason my blitz rating is down, by the way, not that most of you will care, is that I've been playing in tournaments on chess.com. And what some people do is they'll create a new account to play in the tournament. So they're rated like 800 with this new account, even though the real rating is 2,100. And I'm playing against 800s and losing. I don't know why people do that, but in any event, maybe I'm just making excuses for myself. Okay. Stack Java. Okay, what we got here? Remember, he's the 4%, 2.9% dividend portfolio. 4% rule based on the Trinity study. So remember, Bill Bingham came out with the 4% rule in 94. The Trinity study came out, I think, in 98. They call it that because these were professors from Trinity. So anyway, 4% rule based on Trinity study. And by the way, the Trinity study more or less confirmed what Bingham found. The 4% rule based on Trinity study with a 50-50 stock bond portfolio. If you have 100% stocks, I think success is more likely. Well, Bingham found the opposite. He found that success is not more likely based on historical data. Now, you have to keep in mind there's two ways to evaluate a withdrawal strategy, using history or using Monte Carlo, which Monte Carlo just simulates thousands of possible stock and bond and inflation data. The problem with history with a 100% stock portfolio is 1929, right? Over the next 3 years, the market lost 90%. And so with a 100% stock portfolio, that really hurts you if you retire right in that time period. Now you could say, okay, but I'm not worried about that. Fair enough. That would be my concern of having a 100% stock portfolio, particularly if I really do need the 4%. It's one thing if you're living off 2% of your portfolio, in which case, at least based on history, it probably doesn't matter what you do. But if you're needing that 4% adjusted for inflation, for me anyway, you have to make your own decisions. I'm just a guy with a YouTube channel. 100% stocks would be too rich for me. For that reason. By the way, 2000 to 2002 wasn't pretty either. It didn't go down by 90%, but it was a lot. Scott says, is it correct thinking that your Social Security can be considered a bond fund, guaranteed money with inflation adjustments? So I think the answer is yes, but it's not how I think about Social Security. Because The real question that I would have for you, Scott, is why are you asking that question? Because what some people will say is, I want to sort of calculate whatever the net present value of my Social Security, and that will be part of my bond allocation. So if I'm going to be 70-30, and that I'll just make up a number, equals 10% of my investments. So I'll have that as 10%, then another 20% in more bonds, in a fund or whatever, and then 70% in stocks. I find all of that unnecessary and complicated, and could be, depends on your asset allocation, could create problems. The way I like to think of Social Security is simply what's the income it's going to produce, which we know, right? I mean, you can get your Social Security statement, obviously for free. It's all at the Social Security website. And then, okay, so after factoring in Social Security, what's left? How much do I still need to withdraw from my portfolio? And that's your number, right? And then the question is, can your portfolio handle that withdrawal? And so there, I'm thinking, if what you still need to take out of your portfolio, even after Social Security and perhaps other sources of retirement income, is, let's just say, close to 4% of your portfolio in year one, following Bingen, you really need 50 to 75% in stocks, right? Again, based on historical data. And if you treat Social Security like a bond and do it that way, the question I would ask is that throwing me outside of that range? It may not be. Even factoring in Social Security as a bond, maybe you're still at whatever, 65-35. I would at least be aware of that. Now, of course, there are other folks that say, I can live on my Social Security. I don't want to. I want to enjoy some other things, so I do want to spend some of my investments. But if I had to, I could live on Social Security. And if you're in that enviable situation, then you've got all kinds of flexibility on how you think about investing your money. But at a minimum, Scott, I would think about, even if you want to treat Social Security as a bond, you got to figure out how you're going to calculate that. But which you can do it, but you got to make some assumptions, right, in making that the present value calculation. I would still look at, okay, how much am I still going to need out of the portfolio? What's the percentage of that, say, in year one? And then what's my overall asset allocation excluding Social Security? What's my overall asset allocation? Does it make sense in light of how much I need to take out of the portfolio? And by the way, you can model all of this with something like New Retirement. So RA wants to know how you can leave assets to kids and grandkids and minimize taxes other than through a Roth, even with a 10-year rule. Well, the first question would be, how are you wanting to leave them assets? Are you talking about when you die? I guess that's what you mean, leave them assets, as opposed to giving them gifts now. And it's, as a new grandfather, it's something that I'm thinking through. And in fact, I'm meeting with our trust and estates lawyer this month. So I might have some better answers for you. But when you leave assets at the moment through a will, you've got estate taxes to think about, and there might be ways to avoid it, but there you want to talk to a trust and estates attorney. But you do get stepped up basis at the moment, so that can help. And then you got to think about how you're going to leave it to them, like in a trust or whatever. So, but I may have some better answers for you. It would probably be in early January when I would get them to you, and I'll cover it. It's an important issue. But the problem with giving any sort of answers here is that the variations and variables are, because you're dealing with tax laws, estate, trust and estates. If you're leaving it through a will, how big your estate is. There's a lot of issues. All right, what else we got? Remember, if you've just joined or recently, if you want to ask me a question or want to discuss a topic, tag me in the chat because I see it as orange. So if you left a comment and didn't tag me that you wanted me to see, just go ahead and drop it back in the chat with the tag. Just at Rob Berger. It shows up orange. Quincy says, being one of Rob Berger mods would be a dream. I probably do need mods, right, to moderate this and That would be helpful. I don't even know how that works. So if someone wants to do that, please email me. Okay, here we go. This is from Mike. Is there a study that shows relatively safe withdrawal? Example, 3.3% rate represents a 100% safety given historical performance, but what if you're okay with 90% safety? What withdrawal rate? So there's a couple things to think about there. The first thing I would show you is, I think I've mentioned this, but maybe not. I'll pull this up on the screen. I'm not sure this is actually the article I wanted to show you. Optimized Portfolio is a pretty interesting site. Let me actually, though, I don't think that's the one I wanted to show you. No. Is this? Google is not doing a good job showing me what I want to see. Hang on. And my internet is like ridiculously slow all of a sudden. I know this is what I want. Bear with me. So let me just show you this site. This is Portfolio Charts. This was the site I meant to show you. And this is withdrawal. You can just Google Portfolio Charts withdrawal rates and you'll get this. And it's pretty neat site. You can change the allocations here and it will show you withdrawal rates. And you'll notice, what are we looking at here? This is a 60-40 portfolio, right? Intermediate term bonds. I don't know I guess that's just total stock market, right? So like a VTI. And it shows you what's called a safe withdrawal rate. That's this 4.4 number here. But then he has this PWR, permanent withdrawal rate, 3.4%. So what in the world is that? So he's done some calculations using historical data that says, what's the most I can take out if I want to maintain the nest egg that I have on an inflation-adjusted basis? So in other words, if I've got $1 million saved, what's the most I can take out so that one, the $1 million stays there and actually grows by the rate of inflation? So it'll actually go up, assuming we have inflation. Now, that doesn't mean it won't go down for short periods of time, but for long periods of time, what is that permanent withdrawal rate so my money continues to grow with inflation? And if we go back to the screen with the 60-40 portfolio, you'll notice that in short terms, there isn't one, because you can imagine retiring like in the midst of a really bad market, right? But what happens is over time, so for 15 years, the permanent withdrawal rate's about 1.5. But once you get to a 30-year mark, if you're going to retire and you're going to have your money invested for 30 years, it actually gets up to about 3.4%. It actually does that around the 26-year mark and stays pretty consistent. So I kind of, in some ways, I view that as a floor. Again, you got to think long term, though. And there are certain short-term time periods where it could get really ugly. But longer term, you've got that. Now, the other part of your question was 90%. So that's a Monte Carlo analysis, right? That when you think about percentages, because when you're looking at historical data, there's no reason to think percentages. Either your withdrawal strategy would work based on history or it wouldn't. We know what happens. We don't need to think about in terms of odds. Percentages only come up when we use Monte Carlo analysis. And there, I would just recommend, again, something like New Retirement or Personal Capital. Personal Capital is free, so you can start there. But they do a Monte Carlo analysis. Let me see if I can pull it up real quick. Bear with me. So, yeah. So this is a demo account And I've got, this is the retirement planner. So if I go back to the overview, I've got all kinds of crazy portfolios in here of varying amounts that add up to 4.2 million. But you can ignore the number, doesn't really matter. These are just portfolios we've looked at in the past, just made up portfolios, manually entered. By the way, some have emailed me and said, when I sign up for Personal Capital, it forces me to link an account. What I found is if you want to enter your accounts manually, you could link maybe a small account or whatever to begin with. And then once you've done that, you can then enter all your other accounts manually, and you can even unlink the linked account. I don't know why it's set up that way, but in any event, we go back to planning the retirement planner. It looks at all kinds of, it's a Monte Carlo analysis. And in fact, that's why you see this down here, 94% chance of success. And you could plug in here, I put in Rob's Social Security, but you can put in income events. You can put in, if you look at the options, you can put in, you're going to give to charity, you're going to go on a around the world vacation, whatever. And the same thing with income. Maybe you're going to get an inheritance or something, right? You're going to work a little bit. And this will do this is effectively, that's what this is, a Monte Carlo analysis. And you can even create new scenarios where you make different assumptions and then compare them. So I would use one of those tools if I want to get a Monte Carlo analysis of my plan. Yeah. Okay. Ethan wants my thoughts on silver stacking by dollar cost averaging. I like shiny things. Good for prepping. Well, I don't know what silver stacking means, unless that just means investing in silver. Huh. Silver stacking is a term that has grown in popularity and is now used to describe a person who accumulates small pieces of silver like coins, bars, and other hand-poured silver items. So let me tell you a funny story. I think it's funny. When I was in high school, my best friend, his father was big into gold and silver. So I actually invested in 3 100-ounce bars of silver. And I'm driving around in my 82, I'm not that old, 1982 Cutlass Supreme. And for reasons I don't remember, I had the 3 bars of silver under my front seat. And I find myself, I'm from Ohio, but I found myself on the New Jersey Turnpike going north at like 130 miles an hour. Now, it wasn't that fast, but 70 miles an hour. Of course, this is when the speed limit was 55. And it's bumper to bumper. I mean, we're all lined up flying north. And I see this cop car at the last minute sitting in the middle. And I'd sort of do what you should never do. You should just kind of go forward, But I did like this, and we make eye contact as I fly by him at 70 miles an hour. He comes out, pulls me over, comes up to the car. I mean, cars are flying by at like 90. He says, he doesn't even ask for, he must have asked for my license, but first question, what do you got under your front seat? And I'm sitting there thinking, what do I have under? I mean, I don't know, bubblegum wrappers? I don't know. Like, is it illegal to transport silver? I don't know. I said, officer, I have 3 100-ounce bars of silver. He looks at me. Can I take a look? Absolutely. Hop right out. His cars are about to kill me. Get out of the way. He gets on his hands and knees, looks under the seat, stands back up, just looks at me, hands me a warning, and then leaves. Anyway, I love silver. I don't own any, but I love silver. I'm not, the whole prepper thing, I mean, really, I don't know. First of all, if the world really goes to hell in a handcart, our bigger problem is not what can we spend, but I think what can we buy? Right? Won't the shelves be empty? I don't know. I like silver. I want to allocate some money to silver. I got no arguments for me. I mean, I'm not a big gold and silver investor. Maybe the cop just scared me. Maybe I'm just frightened now. I don't know if that answers your question, Ethan, but if I were buying silver, I would probably buy, and I've bought some in the past. I don't have them now. Maybe I'll buy more. They're fun. Is American Eagles. That's what I would do. They're easy to spend if you want to spend them, if you had to. Yeah, like, what are you gonna do with a 100-ounce bar of silver, right? That's no good. So you got to buy American Eagles. You can buy big boxes of them, right? I mean, or tubes of, I don't know what they come in, tubes of 20, I guess, something like that. All right, David says, previously sent you an email about my Fidelity Freedom 2060 K6 fund. K6 is just a share class. When looking at alternative funds available to me in my 401k, most had particularly high expense ratios. Okay. Yeah, they might. I mean, and it's not that that's necessarily a bad fund. It's probably, I don't know what it costs. We'll find out. FVTKX. Yeah, I think K6, I could be wrong. I think that's the share class that's often in 401ks, but I could be wrong. And I often am. Here's the fund. Let's look at fees. Well, this is expensive. Oh, 0.5%. Yeah, so it's a little high, but you know, not the end of the world if it's your best option. If it were my best option in my 401k, I would invest in it and not have any. I'd probably roll over to an IRA or my next 401k if I had better options. But not the end of the world. Can you show a 3-fund portfolio? This is from Darkness Falls. Can you show a 3-fund portfolio where the market continues on a 10-year downward spiral? Well, yes, I can. Anything for you guys. Sure. I'll show you this on my screen in just a minute. I'm going to, as you probably can guess, portfolio visualizer. So here we are. I'm logged in as me. And we're going to look at 2000 to 2009. During this time, the total U.S. stock market actually had a negative compound annual growth rate. I mean, basically, at the end of the 10 years, you broke even if you started with 10 grand. The 10-year intermediate term treasury, you actually doubled your money in 10 years in bonds. So anyway, we can put in here, should be a 3-fund lazy portfolio. Here we go, the Bogleheads. If you're new to all of this, Jack Bogle, founder of Vanguard, a group of guys started the Bogleheads in honor of Mr. Bogle, Mr. Bogle passed away not too long ago. Bogleheads have been around forever. They have a conference every year. Anyway, so here we go. So this is a 80-20. I'm just looking at your question. You don't indicate an allocation, so we'll just leave it at that. And we'll just put 10,000 in there. So in this time period, actually international stocks, I'm pretty sure were higher. Let's see. So here's what I want to do. So these are using mutual funds. So this is total stock market. Well, there it is, total stock market. This is international, right? And this is intermediate term. Oh, no, sorry. It's the bond market, so like a BND. So what I want to do, I'm going to have 2 other portfolios, one that's 100% international and one that's 100% bonds. So I want to compare it. But in the event, the market went down this year. So here we got our time period, right? And we got our 3 portfolios. Let me actually add some names. This will be international, and this will be bonds. Just makes it a little easier to follow, I think. There we go. And yeah, so look at this. The bond fund outperformed because stocks were down, but international was up a little bit, right? But here's the 3-fund portfolio. Obviously not a great year, 2.37% compound annual growth rate, but at least we were up. And by the way, I'll come back down to that for a second, but let's take out the 100% bond for a moment and put it up into US stocks. Yeah, so just, I have to rename it. Hang on, just so we don't get confused. This is now US stocks, right? So for that 10-year period, obviously stocks were down, as I mentioned, just marginally, but, and then the 3-fund, did, all things considered, you think about what we went through, 2000, 01, and 02, disasters. 08, 09, obviously not fun. And it still came out on top for the year. Now, the other thing I want to show you, though, is let's imagine you were a new investor. Just getting started. We'll start you with $1, and you're going to contribute a fixed amount. We'll say you're going to contribute, we'll make it, I don't know, $500 a month, whatever. And we'll adjust that amount for inflation. Fine. We'll rebalance annually. Good, good, good. This is significantly different. What I just showed you, what this shows you is investing a lump sum of 10 grand, right? Now, this is going to show us something very different. And the difference is important because remember, if you're dollar cost averaging, meaning you're just contributing, say, to your 401k, throughout this time period where the market was down significantly at various times and overall down, but you're buying when the market's down. And when you invest a lump sum, that's all you do. And when the market crashes, as it did twice in that decade, you don't continue to invest. We just looked at a lump sum. But if you're contributing to your 401k every paycheck, an IRA every year, you're buying in even when the market is ugly. And so when it then comes back, that investment's really paid off. So the numbers look totally different when we make this change, or they should. If they're the same, then I won't have an answer for that. Okay, I've analyzed the portfolio. And obviously the ultimate, and you have to ignore these compound annual growth rates, but it's going to be a little hard to see. The U.S. stock fund still underperformed. I just really want to look at Indian balances. The 3 fund, because international, as we saw in the first screen, outperformed U.S. stocks. But my point really is that, a 3 fund portfolio, you'd have done just fine. Even with a max drawdown, as you can see here, of 44%, you'd have been good. So, yeah, there you go. By the way, that's why I'm not a big believer in a U.S. stock-only portfolio. There are periods of time, long periods of time, when international stocks will outperform. It's also why I'm not a believer in a 100% stock portfolio. So Ron says, I only need about 3 to 4% return on my investment to meet my income requirements for the next 30 years at a high level. What are your thoughts regarding getting this return on investment safely? Well, a couple of thoughts, Ron. My first question is, let's put numbers to it. And this obviously, I don't know what Ron's specifics are, but let's say you got $1 million and we'll just use 4%. You want to get $40,000 a year from this $1 million. And you think to yourself, is there some fixed income that will get me 4%, right? And if I can get some fixed income that I'm confident will give me 4%, then that's all I need. Well, the first question that raises is, do you need this, in this case, 40 grand to be adjusted for inflation? 40 grand today is a lot different than 40 grand 25 years from now. So that's the first question. The second question is, a lot of these safe investments can actually go down in value. So could we find a bond fund that pays a 4% yield right now? Sure, right? Let's see here. Let's see if I can find one. Let's see what this, I'll show you this in a second. Oh, it's close. What's in your 3 to 4% range? This is Vanguard's high yield corporate fund. High yield meaning it invests in junk bonds, which are funds that are below investment grade. Don't read into the word junk. That doesn't mean they're a bad investment per se, but they are riskier. I just switched over to the Admiral shares. So they got a slightly higher yield. Their 30-day SEC yield is 3.3. That's in your range. And if we go to Morningstar and take the ticker, we can see their trailing 12-month return, or not return, but yield. That's what you're focused on. Yeah, it's actually 4.32. So what's the problem, right? Well, the problem is that these funds can actually go down in value. So even if the yield stayed the same, so let's just round it to 4%, That's a problem if your $1 million portfolio in junk bonds goes to 850,000, because now when you multiply it by 4%, you ain't getting the same $40,000. And if we go to performance, let's see we'll see what kind of returns it's had. So you can see a lot of years it's been good. Well, I'm looking here, but some years have been negative. Now, when I look at this, doesn't seem too bad, but you got to be aware that these funds can lose money. And keep in mind that this is a total return, which includes the yield, as well as any changes in the net asset value, the value of the bonds that this holds. So my point is you can do something that seems at least reasonably safe, not that I would call junk bonds safe, but reasonably safe, and end up not achieving your goal. We could look at something that most would say is safe from a credit perspective, and that is, we could look, I'll pull it up on the screen, Vanguard Long-Term Bond Fund, right? So here it is. If we go to we can see the yield is just under 3%, so you're close. And you can go to the portfolio and we'll see the credit risk is medium, which means it'll be investment grade. Yeah, you can see here's the bond portfolio. There's nothing below triple B, which is the lowest investment grade rating. The yield is lower on this because this is the credit risk, the risk of default is lower on this fund than the high yield fund we looked at. And if we go to performance, it can lose money. It's probably lost money this year. And not much, but it's lost 1.42%, and that's factoring in the yield as well, right? But it's had big years. Last 2 years were huge, but it lost money in 2018, lost money in 2015, lost big time in 2013. So all of that is to say, I get very nervous. I would personally be very nervous with this idea of trying to generate 4% income from a portfolio. I think you end up in investments that may not accomplish what you want. And what seems less risky turns out to be actually taking on more risk. Sometimes we end up putting ourselves in very risky positions in an effort to avoid the risk. But a specific portfolio, I don't have a recommendation. I mean, this is where, and Ron, I don't know how new you are to my channel. I'm just not a believer in focusing on yield, dividend, or interest. I focus on total return. And that's my approach even as I near retirement. For those kinds of reasons, there are funds that you can earn a yield of 9%. You can get a fund that leveraged or that uses options to generate lots of income, but your total return won't be that great. And so, what you're earning in yield gets taken away in the underlying asset value. It's probably not a very satisfying answer for you, but that's my opinion. Skilver, not silver, but Skilver says, what do you think of the Eurozone producer price index this morning at 21.9%? I hadn't seen that. That sounds high. Let me look this up. By the way, this is the keyboard I'm clicking away on. I love this thing. It's a mechanical keyboard, the F96. I'll pull something up on the screen here. Let's look at news. What happened? The euro, I don't know what site this is, but the euro was little changed today, even after the strong Eurozone producer price index data. According to Eurostat, the bloc's factory gate prices rose to a record high of 21.9% in October. This was a substantial increase from the previous 16.1%. On a month-to-month basis, 2.8. Boy, that's pretty significant. But I suppose I don't generally read too much into a single reading. But I mean, prices are going up. There's no question about that. I just don't know what the future holds. The cost of this show has remained the same, though. So if they factored that into the CPI, I don't know. Maybe we wouldn't have any inflation at all. Paul says, "Hi, Rob. I'm a new retiree and investor. Congratulations. Are you a new investor? How did you retire?" Anyway, I have a 60% bond Vanguard ETF. So I assume 60% of your portfolio is in a Vanguard bond ETF. It seems I take more risk for little return as opposed to just a 0.5% savings account. Thoughts? It's an interesting question. It depends on the bond fund, first of all. So we have to think about a couple of things. Depending on the bond fund, there may be tax advantages, right? If it's a muni or even a treasury where there's no state income tax. Of course, it depends where you live, but I'll just throw that out there. There are sort of tax implications that you might want to think about. And actually, you can do a little better than that on the savings rate for what that's worth. I think Axos Bank is at 61 basis points right now. I have it as on the list of my best banks on allcards.com, or one of the best banks. Savings. Yeah, it's 61 basis points right here. Anyway, just pointing that out. By the way, did you know that Axos Bank used to be named Bank of Internet? Now you do. Okay, so it depends on the bond fund, right? So like if you're in a short-term treasury fund, and let's look at that. I'll pull one up. You're not taking much interest rate risk. I want to look it up in Morningstar. Here it is. This is the mutual fund version. And what I want to look at in the portfolio is the duration. I'm going to guess it's around 2. Yeah, 1.94. So there's not a lot of interest rate risk. There's some, but not a lot. And then the question is, I guess to your point, Paul, what do you get for that? There is some risk, though, right? If interest rates do go up, the value of the fund will go down, at least in the short term. Eventually, the rising rates result in higher yields as the fund buys new bonds, and that will eventually make up for the loss in asset value. And if you were on the stream at the beginning, you know how long it takes. Duration of the fund times 2 minus 1. So in this case, 3 years, not that long. In any event, so what are we getting for this risk? Well, not much, that's for sure. The trailing 12-month yield is only 28 basis points. Boy, that's lousy. Let me briefly look at the SEC yield, which is a 30-day. It's an annualized yield based on distributions over the last 30 days, effectively. So you think trailing 12 months factors in, well, the last 12 months, but maybe interest rates today are very different than they were 10 months ago. So you want to look at the SEC yield as well. And we can get that on the Vanguard site, I think. Yeah, it's still not much better. So that's 31 basis points. Now, again, this is a short-term treasury. So I'd probably, a savings account probably makes more sense. You do have to factor in how much you have. A savings account is FDIC insured up to $250,000. There are ways to increase that. You could open multiple accounts at multiple banks, and there are other ways to do it as well. So you want to factor that in. But if you're in like an intermediate term bond fund, you're going to get a higher yield than what a bank offers, but you're going to be taking on some of that extra risk of rising rates. I mean, the reality is what we're all trying to figure out is how to safely get more yield, right? We had that question a moment ago, and there is no way. In a savings account, you're guaranteed to lose money on an after inflation basis. Guaranteed. It will happen, right? Inflation's above half a percent. So I don't have any easy answers for you. I tend to keep my money in intermediate term bond funds generally. I have some in short term bond funds because I haven't decided what to do with it yet, but there's no easy answer. Craig wants to know, what do you think about investing for dividend growth versus overall growth in a total market or S&P 500 index when someone is 15 to 20 years out from retirement? Well, we've talked a lot about dividends and a total return. I tend to be a total return investor. I don't tend to be, I am. For individual stocks, I do prefer companies that pay a dividend, but I'm still focused on their total return. Now, you can focus on dividend growth, and there's some good funds, right? We've talked about Schwab. Pull it up. It's a great fund. Here we go. SCHD, right? Schwab US Dividend Equity. The real question, I think, Craig, for you is when you think about dividend growth, you're generally investing in what would be value stocks. Yeah, and this one's actually considered a value fund, according to Morningstar anyway, and we can see it in the box. Right? It's in the value column. And over the last decade, growth has clobbered value. Over other periods of time, value has clobbered growth. I think it's likely that value will win over the next, what's your time period, 15 to 20 years? If I had to bet, that's what I'd bet on. Of course, I could be wrong. And so that's really what you're betting on. You're betting that, and not that you have to use this specific fund. I'm just using this as an example. I don't own this fund, by the way. But you're betting that value is going to outperform growth, at least to some extent. That doesn't mean you put all of your U.S. equity in this fund. You might still have some in an S&P 500 or total stock market, but this is true with any factor investing. You're making an educated guess that value will outperform over your time horizon. The trick is, can you stick with that no matter what happens? The problem is when people go from one reasonable portfolio to another reasonable portfolio, and then on to another third reasonable portfolio, and that's just a good way to lose a lot of money. The hard part with factor investing, whether you're focused on small cap, value, maybe you're tech and growth, whatever, is that there are going to be long periods of time when the factors that you've bet on are underperforming. They just will. And then what do? So if you don't think you want to mess with all of that, I just right down the middle with a total stock market, S&P 500, same thing on the international side if you have international stocks. If you want to sort of dive into certain factors like value and growth, small cap, then just recognize you need to be prepared to stick it out and think about it. Value outperformed growth for a very long time. But if you're a value investor and you've got a lot in like the Schwab fund we just looked at, and it's done well, but this particular fund, but you've underperformed heavy tech growth funds for a decade. So the question, Craig, I think is, are you willing to do that? And to do it with uncertain as to what the outcome will be. Uncertain if all of the pain will end up rewarding you at the end of that 15 to 20 years. That sounds so depressing. I almost want to cry. Is it almost 1 o'clock? Holy cow. All right, well, I'll keep going for a little bit. Although I'm kind of tired, I'm parched. Singh asks, would the inflation be different when the debt to GDP ratio starts increasing in the decades after the 2020s? I don't. The short answer, of course, is I don't know. I think there are a lot of things going on that, to me, make inflation a really big risk. We've flooded the economy with money. Our debt keeps growing, which if interest rates do start to rise, the impact on our debt, federal debt, national debt, is going to be huge as it sucks up more and more of our annual budget. And I mentioned this in the past, and I try to do this as apolitically as I can, but there's two things kind of going on with our current government. The Republicans cut taxes, by and large. And then when the Democrats get control, they raise taxes, but they do two things. One, and this is true in the current proposal, the Build Back Better proposal, they don't use the taxes to lower our deficit, to say, hey, Republicans lowered the taxes and that was irresponsible. We need to fill that hole back up, so we're going to raise taxes. That's not what they do. They raise taxes and allocate the money to new social programs. Again, putting aside whether the programs are good or not, it's sort of a double whammy. We get our deficits go up with the lower taxes, and it may help the economy, but I still think long term our deficit's going up. And then the Democrats raise taxes, but don't use it to fill that hole. And in some ways, they use it to create future holes with future unfunded liabilities for us. So the two of them are like working together to clobber us. And the other thing that's happening is the Republicans tend to lower taxes across the board. There's certainly arguments that they favor the wealthy, and I don't want to get into that, but they certainly lower taxes across the board. The Democrats come in and they try to raise taxes only on the wealthy, however that gets defined. And so that creates a problem because even if we wanted to take whatever, I don't care, the 100 richest people in the US, the billionaires, and forget tax rates. We're going to take all your money. You got nothing. Sorry, Elon, you're broke. It's a drop in the bucket. It doesn't solve any of our problems. And so the reality is, at some point, we're going to have to, I hate to say this, tax the middle class. They're the ones with all the money, not individually, but collectively. And so all of that, to me, I don't know. I think we're in for some challenging times, and I think inflation could be part of that. And if the Fed really, really fights inflation, that could cause it could cause more problems, right? Because it could raise rates, causing the government to spend more in interest, not immediately, but over time. So this has just become a depressing show. This is awful. I don't even want to watch. Anyway, that's my take. All right. So Joshua, I missed this one. He says, what do you think of using Personal Capital's advisory services? You say fees are about 7 basis points. I think you mean 70. And actually, I think they're more like 90. They have some interesting, so they do direct indexing. And so they have some interesting services. But I'm just a do-it-yourself, low-cost investor. So I wouldn't. But, I wouldn't use someone charging 30 basis points. I mean, anything under 1% is probably below the average. But Vanguard offers 30 basis points. But, even Vanguard services, I've come to have some issues with. In any event, so I wouldn't use it just because of the fees. But beyond that, I don't. Some people have used it and have told me they're very happy with it. But to me, it's kind of expensive. I do like their direct indexing approach, but that would only matter really, sorry to say if you have taxable accounts, but I think what they do is actually spread it across taxable and retirement accounts, which is kind of interesting because you think you'll have the high dividend payers in the retirement account. I don't know how that does with tax loss harvesting, but they have computers that deal with it all. So here's a good question from Rodolfo. On a 401k rollover to an IRA, does the IRA count, will it be a Roth or a traditional? Well, it depends what your 401k is. If you have a Roth 401k, it'll be a Roth IRA. If you have a traditional 401k, you should roll it into a rollover IRA. And you might say, well, why wouldn't I roll it into a rollover Roth IRA if I had a Roth 401k? They don't exist from what I can tell. And I don't know why. What's the difference between a rollover IRA and a regular IRA? It segregates money just from 401ks that have been rolled over, thus rollover IRA. Why would you care to do that? Well, you get some added protections from creditors potentially, and if you get a job later with a 401k, they might allow you to roll over some IRA money if you want to, but only if it's in a rollover IRA kept separate from other IRAs. I know you didn't ask all of that, but the point is, if you have a Roth 401k, it goes to a Roth IRA. If you have a traditional 401k, it goes to a traditional IRA. And if you have a Roth 401k with employer matching, the employer matching always goes to a traditional 401k, even if your contributions go to a Roth. So when you roll that over, you'll roll it into 2 separate IRA accounts, one Roth, one rollover. And I just did that not long ago. And I was using, I'm actually, so I just left Forbes. I was only doing one article a month, but I officially left Forbes 2 days ago. I'm still a contributor, so I'll still write for Forbes, but I'll roll over my 401k probably this month, and I'm going to use, I've talked about them before, Capitalize. They're free service. I'll talk more about them in a future show, maybe. It's it's HI Capitalize. Here, I'll show you on the screen. HICapitalize.com. I've talked to the folks there. So it's a free service where they help you roll over the 401k. They make money if you choose to roll it over into a new IRA that they help you open, where the IRA provider would pay them a fee. But you don't have to use that. You can pick whatever you want, and you can even roll it over into an existing IRA. So pretty cool service. I'm going to actually use it. And once I do, I'll let you know what I think. All right. Daniel says, how do you think about asset selection, location, and rebalancing with 95+% of assets in taxable? Traditional advice is to rebalance in an IRA isn't very useful. Retiring early in 5 years. Yeah, I have a similar problem. I don't have 95% of our assets in taxable accounts, but it's about 65 or 70%. And so I tend to not rebalance very often. Although I have more in retirement, so I can make use of retirement accounts. And one of the things you want to do is have at least all of the asset classes you can represented to some extent in a retirement account. Now, in your case, you might not be able to do that. You don't have that much in retirement accounts. I will tell you that I did a video on opportunistic rebalancing. And I'm going to show you the paper. Let me make sure let me find it. Maybe this is it. Nope. Well, that's it. But where do I get the paper? Here it is. Is it? Yeah. Here's the paper that video is based on. And I won't go into opportunistic rebalancing. You can check it out. I think it'll be useful to you. So if you just Google, this title, here's the author. I think it was from 2008. Let me just make sure this is the right paper. Pretty sure it is. But yeah, it is. He points out, so one of the things he says is, you have this band where you'll let your asset class vary by a certain amount, and you'll only rebalance once it goes beyond this band. But when it does, you won't actually rebalance back to, let's say you have an asset class where you want 30%, and it's gone to whatever, 36%, and that's triggered a rebalancing. You won't actually rebalance all the way back to 30 if that's going to trigger taxes. Just rebalance halfway back. So at 36, you rebalance back to 33. And the paper concludes, yeah, that's good enough. It also concludes, as I recall, that, yeah, even with that, there might be a tax hit, but it's generally worth it. But you can read it and make your own decisions. I hate paying taxes. I've avoided rebalancing in my taxable account. Another thing that kind of makes it easier, the fewer asset classes you have actually kind of make it easier, because it's easier to span them across different accounts. Now, you mentioned location. I don't put a REIT in a taxable account. You never put a muni in a tax advantaged account, because you'd accept a lower yield for tax advantages that you would never benefit from. Okay. So Ron, who I answered the question, responded to a question on his, I think that was the generated income. He's concerned about sequence of returns risk. I would add to that sequence of inflation risk, right? Because it's the same kind of problem. But remember, the 4% rule was the worst case scenario that we've experienced, and actually others have run this analysis out to 1871. It's, it was based on the worst time period to retire, which happened to be the late 60s, because of sequence of return and sequence of inflation risk. Now, that's not to say that we couldn't, and I suppose some year we'll encounter a year that's worse than the late 60s. Maybe it's now, I don't know. But it was pretty bad. I mean, most years, there were some years you could start with as high as 10%. So that gives me at least some comfort. Yeah. But yeah, sequence of returns risk, your first 10 years of retirement, I would probably tighten my belt if, stocks drop by 30% or inflation hits whatever, 8%. It's funny that we see 8% as a horrible inflation. I remember 16% on a 6-month CD. Okay. I'm past the 1 o'clock hour. I promised I was going to stop myself. I was going to stop at 1. So I think I'm going to call it a day. I know there's a few questions that I didn't get to, and I'm sorry. Haven't decided when I'm going to stream chess, and I think you can follow me on Twitch, and then you'll get. I guess you'll get a notice. I don't know. I may stream later today, but for chess fans, that's what I'll do. I'm going to come out hopefully tomorrow, but we'll see, with a bond video, because just tons of questions there. And as always, I appreciate you guys hanging out with me. As I mentioned, I will get a timestamp list up sometime by the end of the day or early tomorrow morning. And there you go. Well, hope you enjoyed the show. As always, thank you for joining. And until next time, remember, the best thing money can buy is financial freedom.